In the first event session, we have two speakers. The first speaker is Professor Hoi Ying Wong from Department of Statistics at CUHK. And Professor Wong will talk about simulation-based value at risk for high-dimensional nonlinear portfolio.
Thank you for the introduction, and thank you for the invitation from the organizers. And today, I'm very happy going back to Hong Kong UST as I'm a former graduate here. I'm receiving my PhD degree right here, and also to see my former PhD advisor sitting over there. A bit nervous, okay? And so today, I'm going to talk about this simulation-based value at risk for high-dimensional nonlinear portfolios. It's a joint work with our colleagues, Tony Sid in our department, and also our joint supervised graduate student, Yuki Chen. So what's the topics about? So this topic was about teaching, okay? So I've been teaching the risk measures for almost a decade. And then lots of practitioners in my class asking about the implementation of their value at risk framework. And initially, I was almost convinced by them that the current practice would be quite excellent, and then not much has to be learned, okay? And later on, I find out that it may not be the case, and then there are lots of improvement probably suitable on a simulation based. So let's take a look. So if you don't have any idea of value at risk, it's very simple. It's kind of risk measure. For example, you would like to look at the risk of your portfolio tomorrow. Then what you're going to do is that you're going to generate possible scenario of your portfolio tomorrow. Suppose that you're going to be able to produce 100 scenarios, okay? Then this 100 scenario would have 100 possible returns. So you rank them from negative to positive, okay? And then you read off, for example, you want to calculate 95% value at risk. It's very simple that you rank them all, okay? You look at the fifth worst scenario return, that is the value at risk of 95%, okay? Very simple, okay, basically, conceptually. But what is the major problem is that is the portfolio itself. The portfolio itself that you want to generate scenario tomorrow seems to be very difficult. In particular, the portfolio that nowadays is a nonlinear type. You can express your nonlinear portfolio as a conditional expectation up to the information of today or tomorrow. If you want to calculate your portfolio value tomorrow or 10 days after tomorrow, there's the information that will be produced 10 days after today, and then you compute the expectation of the nonlinear payoff subject to many possible risk factors, okay? And this kind of portfolio, you can call it a European style portfolio. And typically in the financial market, or later on we can see in the insurance market, we have the American style. So that means the portfolio itself enables you to do some of the optimal actions through time. That action could be optimal stopping or maybe surrender right. So now what are you going to do? Imagine you're going to reproduce the possible scenarios over time, not only one day, maybe several days after today, by reproducing all this kind of sub-expectation every day, okay? So how this can be done? So if this F happened to be linear, then it's simple. You go back to a linear portfolio. If this F happened to be like current situation is a kind of a nonlinear function or unknown linear function, then it goes back to a nonlinear portfolio. Remember that why people need to calculate VAR, value at risk, because nowadays the banks or even though the financial institutions are holding very complex portfolio. If it's only linear, I do think that there is no any regulation on it, okay? So because of the nonlinear nature, that's why we need to compute VAR and eventually go back to fundamental. Basically, on all the textbook only teach you how to compute the VAR on linear portfolios. So that's the problem. And here is two big questions in computing this value at risk. First of all, you have to obtain the pricing accurately. That means before you forecast the quantile of this function, you have to compute this function accurately. So that is called pricing, okay? If you can obtain the price accurately, you have to rank them. So that means you have to compute the risk or the quantile accurately of this nonlinear portfolio. So that means you have to do these two things together. So now, let me explain to you why VAR is important if you don't know, okay? So in the banking sector, basically, all the bank has to report their value at risk on a daily basis. They have to project their 10-day, the value at risk of holding the portfolio for 10 days. They got to report this on a daily basis. Every day, report a 10-day value at risk. And then based on this number, they're going to compute the so-called capital charge. That means how much money they're going to retain, not investing, is based on this computation. Okay? And every bank has to do it. In addition to this, for insurance company in Europe, recently introduced so-called Solvency II. Solvency II is similar. They have to compute the value at risk for retention of the capital. The major difference in Solvency II is that for banking sector, the value at risk is required for a 10-day portfolio. But for Solvency II, you have to hold the portfolio for 1 year. There's a very strong implication. For 10 days, you can make use of Taylor series, assuming that the portfolio value not change too much, so you can calculate the derivatives of your portfolio and then project the corresponding value at risk. People call it delta normal approximation, delta gamma approximation, and so on. But right now, you have to hold your portfolio for entire year, like Solvency II. Can you assume that the Taylor series expansion still be accurate? So that would be a big question, okay? So that means the ordinary implementation in the banking sector, even though it works, okay? But I can show you that it doesn't work later on, okay? Even though it works. Yeah. Yeah.
I'm not familiar with Solvency II. What is that exactly?
The Solvency II is the new regulation imposed for insurance company, not for banks. So insurance company has to compute their value at risk same as the bank, but they have to assume that they hold that portfolio for 1 year because they receive the insurance premium for a year, right? Supposedly, okay?
That has nothing to do with Basel.
Not Basel, nothing to do with Basel. Basel is only governing the banks, okay? Solvency II governing insurance company, okay? All right. The third one is on the margin charge. So in the old days, when people doing deals over the counter, they just make a phone call, okay? But right now, they have to compute the margin charge as well. So the margin charge calculation is also based on the value at risk. So that means now every day you have to do this so-called nonlinear. So for OTC derivatives, it's exactly a nonlinear portfolio. Then you have to compute the value at risk and compute your margin charge. So it's a practical issue. So now go back to banking sector first, because it has been implementing the Basel for many years, for almost a decade. So there's a survey paper shows that, so what is their methodology? 73% of the disclosed bank disclosed that they use the historical simulation. Okay? 21.5% of them using Monte Carlo simulation, okay? Remaining of them not specify. All right? So that means nowadays, basically, almost at least banks are using simulation framework. So if you teach like normal VAR, then I don't think that there's any practical usage, okay, at all. And also from this survey paper, they find out the following interesting phenomenon. All the banks in this sample, okay, significantly overstate the value at risk. So that means they are over-conservative. So in principle, in 1 year, they're supposed to have 2 to 3 exception of overvalue the VAR, but in practice, this number would be 0, or at least at most 1. So the implication is that most of the banks retain too much, and they do not do an optimal investment because of the retention. So it is a survey article that found now in this way. So let's take a look at the classical problem. In the market, one way of doing this value at risk is following. Suppose you have a vector of underlying risk key factors. So you're going to simulate them for 10 days for many scenarios. Under each of the scenario, you do the nested simulation under Q, the pricing measure, in order to produce the expectation if there is no early exercise right, okay? If there is no early exercise right, then you're going to reproduce many scenarios over here, and then you can come up with the portfolio value T1 day after today, and then you can rank all these scenarios, okay? But do you think that it is really doable? You can see you want to generate millions of paths over here, and in each you generate millions of paths, so you generate millions to the power square of paths for one scenario, and one scenario maybe consists of thousands of assets. So I don't know whether the parallel computing so far can do this job. So it is a typical picture that we can think of, but nobody really do this, okay? Even though there are lots of paper contribute to the optimal allocation between the paths right here and the paths over there, okay? But I don't think that they are really implementable. Now, a very simple idea is that instead of generating many paths extend from all these points, can we simply generate one additional path out of each of these points, okay? Without doing the 1 million to the power square, but I only simulate 1 million paths. Is it possible? The answer is yes, somehow, okay? So based on the paper of Longstaff and Schwartz, this paper is originally used for computing the American options over optimal stopping time. So the idea is very simple. If it is a European style portfolio, the portfolio itself, you see, is an expectation. As an expectation, conditional expectation, if the process is a kind of Markovian, then you can simply replace the conditional expectation in the sense of regression, right? Simple statistics. So that you can take the regression over here, you generate only 1 million paths, you take the regression over here, okay? And then you approximate the expected value, you rank them. Then you can read off the value at risk. Is it sufficiently simple? Okay? So there's one way to do this. And of course, there are issues when you have only one asset. You're doing this may be efficient. But if you have thousands of assets, then how many regressors that you have to take care of? Remember that when you use this Longstaff and Schwartz of style, you expand it into polynomials. You approximate the expectation by polynomials, okay? You have 10 assets, polynomial degree 3, there are thousands of regressors, okay? And now you have thousands of assets, so if you expand the polynomial up to degree 3, it is 1,000 to the power cube order, okay? Not only this, even though you expand up to third order, may not be necessarily sufficient, okay? So how to select the appropriate basis function would be another question. So you may think of like this one of very familiar financial product. You call the best of option. You compute the best pay return of or underlying asset over a certain time. So suppose you only have 10 stock, not many, okay? Suppose you only have 10 stock. Then you have 10 underlying variables to the power cube, 10 to the power cube. And you take a regression, okay? Would it be very accurate? Okay. Now, on top of the valuation issue, we want to compute the value at risk in this manner. We compute the difference in the portfolio value at 2 different time points to be less than this threshold. This threshold is the value at risk. Basically, you're computing quantile, okay, of any specified confidence level. Let me go back to the classical industrial method. The classical industrial method is following. You have a portfolio, then you try to compute the portfolio derivative. Okay? So by computing the derivatives, you speculate that the Taylor series expansion works quite well. So you freeze the delta. Or also you freeze, this one is called the delta approximation, for instance. You freeze the delta and treat this one as a constant. So you regard your nonlinear portfolio as a linear portfolio. And then you freeze this one and only compute the difference. So you associate all the noise by the difference in each of the risk factors. okay? And then you project your value at risk. Then it's called the classical delta normal method. An interesting question is how these delta are computed in practice. Because you don't know the model, right? Originally, what you want to do is to do the non-parametric types of simulation. You call it bootstrap or historical simulation. But when you go to compute the options, how can you compute all these deltas? It seems to us that computing the delta is very challenging. Okay? So in practice, people do in the following way. So in this P region, they really sample them non-parametrically. In this Q region, they take a model like Black-Scholes, right? Forget about the connection between P and Q. Based on Black-Scholes, you have some closed form solution, you compute delta. Okay? It's called the industrial approach. But it is kind of inconsistent because now you want to make all the things non-parametric over here, but suddenly you jump into some certain model. Okay? Now, it is the current market practice. So let me summarize. In the panel B, problem B, risk management. The classical approach has to compute the delta, and the approximation error is, you call it, moderate for short holding horizons. However, for a solvency to like insurance company, that you have to compute 1 year, then the quality would be questionable. And maybe you can use the least square method proposed by the Longstaff and Schwartz, but you have to select the appropriate basis function, okay? And imagine that today, everybody, in particular universities in Hong Kong, are advocating so-called global business program, right? So global business means that you want to invest in the global economy. So look at World Bank data. In total, the listed domestic company in the world with over 47,000 stocks. Only talk about stocks, not mentioning commodities, interest rate, okay? So you say you want to do the risk management in the globe, you have to do this kind of scale, okay? You do the simulation, regression, expand it to third-order polynomial over this scale. So if you really want to do global business, then you have to think about how this issue could be solved. So even though you contain yourself in US, there were more than 4,000 listed firms, okay? So it becomes a high-dimensional problem, though, okay? Now, our idea is pretty much very simple, very, very simple. It's following. We follow the Longstaff and Schwartz approach of generating all possible sample paths, okay? And when we take the basis function, similar to the previous thing, we just add one statistical technique that has been developed in statistics for many years, that is lasso. The lasso, we do the model selection for you. That means there are infinite many, you can expand it to infinite many basis function, and the lasso, when you run the lasso will select the most important one for you. And then you take regression along those selected basis function. The point, okay, the methodology is very simple, okay? You can finish the talk, okay, if you really want to borrow the approach, okay? The point is that even though the portfolio itself is American in nature, that means you have the many optimal exercise rights. You can still continue using this lasso, okay? The final point is how to prove it converge when you have lasso, okay? And also how it can be prove it to be converge for the value at risk as well. It is a major contribution of this paper. We prove them to be converge, okay? And we also prove that when the portfolio size gets large, if you do not use lasso, the ordinary regression is not guaranteed to converge, even though in the small scale problem. Because when you expand the basis function to infinity. Okay? So here's the idea that we use the lasso algorithm to select the basis function and then rank them, okay? So I don't think that now. Now, go back to the literature. After Longstaff and Schwartz introduced the least square method, there are many papers attempt to prove that this method converge for American option. So for us, we have two missions. One, after you introduce the lasso, you have to prove that the American option price under high dimensionality converge. This is the first question, okay? Second question, after you use this to rank the value at risk also converge to the true value. That would be the second question. So first tackling with the first question on the original Longstaff and Schwartz paper was solved by this group of people, okay? They proved the following basically. Originally, we think that they solved the problem. But ultimately, when you read it carefully, we thought that they do not really solve the problem completely. They solve the problem in the following sense. Suppose you run a regression, okay? Run a regression, and the regression coefficient contains no error. Okay? If the regression coefficient contains no error, okay? It's a big assumption, okay? Big assumption. Then by increasing the number of basis function to infinity, the method would converge to the true value. Okay? It is not easy because it accommodates also the optimal stopping rules. Unlike a simple regression you can show this simply, right? Because you only do one regression. But right now you have the optimal stopping rules backward in the simulation. But the big assumption is that the coefficient obtained from the regression contains no estimation error at all, okay, from their paper. The second way of approaching the problem is that suppose you fixed the number of basis function, m, not letting it to infinity. Then the coefficient, the estimated coefficient from least square would tend to the true coefficient, even though you introduce this kind of loop. Okay, this is the second layer of contribution. But by mixing them together, they did not solve. Because when you mix them together, when the number of basis function tends to infinity, you cannot come up with a closed form solution into the regression coefficient. You cannot write down the proper formula. Okay? So now, under our setting, even though a low-dimensional problem, remember, even though there's only one risk factor, you expand it to infinite sum, like polynomial, second-order polynomial, third-order, fourth-order, and so on, okay? You have to stop right somewhere in order to guarantee the convergence, right? So suppose we allow you to run it to infinity, and if you adopt the lasso, then you can prove that it converges. Okay, so it's one of the major contribution. Okay. Secondly, so it is our theorem. Okay. Secondly, the value at risk also converge. Okay, value at risk also converge. Okay, so it's a technical part. So I'm running out of time. So it's some of the technical assumptions on the smoothness of the functions. Okay, so let me give you some example. Then you can see it better. Now suppose that we are considering and best of option as your portfolio, European style, and then we go to American style later on, okay? A European style portfolio, we consider the following items. One is the ordinary least square, the Longstaff and Schwartz method without lasso. This one run with lasso. We only consider 10 assets, not a very huge portfolio, okay? Only 10 assets, okay? Because the computational cost for the Oracle is already very expensive. Okay, so in the Oracle part, we really simulate everything intensively, okay? So now, you look at the back test. We are going to test for the 95% VAR. So the perfect one, we have 5% bad test. So you look at all these numbers. The delta normal, 0.4 something, not bad, okay? If you use the ordinary least square, without using lasso, 0.3 something. If you use lasso, it's pretty much close to 0.05. And the implication is that if you use the delta normal, this number is bigger than this one. So you have to reserve more capital. Agree with what the survey did. Okay? And also, the delta normal approximation here is quite well, but when you change the strike price, that means if the point is near the non-smooth points, the quality deteriorates sharply. Now, this one is the empirical analysis, real data. So when you want to trade on the OTC market, typically you want to trade Bermudan swaption. Let's start with European swaption first, okay? So we run the LIBOR market model. So LIBOR market model can only rely on simulation, okay? Then, so it's a LIBOR market model simulation and capturing the instance correlation structure. So look at the number. So the number here is that the Oracle 0.05. So after using the lasso, not perfect, but it is the closest to the Oracle, okay? If you simply use delta normal, very far away from that, and a huge computational time, remember, because computing delta is not cheap. It's also very costly. So compared to this SLSM, it is a subjectively selected basis function according to Longstaff and Schwartz paper. I believe they select the basis function by going through many experimental exercise, okay? So that means they do the model selection in an informal manner. It should be a very good thing, but still not better than the lasso-peck basis function. So this GLSM is that we only look at those without the cross term in the third order polynomial. Then it would be very poor. That means if you select it arbitrarily, it would be very poor. And it's overstayed the value at risk by a very large amount. It's quite consistent with the survey. Okay? How about American? So you can see the distribution. Come on. Yeah. So for Bermudan swaption, we don't have Oracle because it's too expensive to run the Oracle every time. So we don't have an Oracle. We only have these types of number. So how can I know which number is better? So we do this kind of exercise. No. So that means if you look at it, not the value alone, not so too much difference. Okay. Yeah. So in this table, you can see no matter which method that you use, okay, the subjectively selected basis function, ignoring a cross terms or the lasso-peck types of a regression, you can find out that the more number of possible stopping time, the decrease in the value at risk. Okay, you can see this trend. So why this number is important? After you recognizing that the value at risk trend is decreasing, that means the Bermudan swaption has a smaller value at risk than their European counterpart. Then we compare these two tables. The Oracle value at risk of the European swaption would be this number. Only the lasso types of least square can produce a number smaller than this number. Others are larger than. That means only this number would be a viable approximation. Others are just wrong. Okay? So for American style types of derivatives of high dimensional, probably the existing method or overstay value at risk. Okay, so time for conclusion. It's a very simple idea as you know how to run statistics. Statistics is that ultimately I will give you an algorithm. This algorithm is a slight modification of your current practice, but make a big change. The current practice is that if you run a regression on a daily basis on your value at risk as a practitioner, very simple. You just use the package of lasso, rerun everything, get done. Okay? And there's a theory to protect you. Okay, for value at risk purposes. And this now you can implement for the Solvency II. Solvency II will be truly implemented in 2016. That means this year. Okay, so thank you.
I'm not quite clear about the portfolio the concept portfolio in your talk. Mm-hmm. And your portfolio, your examples, the assets are quite similar. They have the same, for example, they are the rainbow options of the swaps. They have the quite similar properties. How about if the assets are quite different?
It doesn't matter. It doesn't matter.
Okay.
It doesn't matter. So the methodology does not depend on the kind of the asset class. So what I'm going to show you is that why I picked rainbow option, okay? Because rainbow option has a closed form solution so that I can do the numerical implementation better. And why I picked swaptions, because swaptions is a very popular OTC product that you have to do transaction every day. So you need to calculate the margin. So that's why I use that kind of example. But if you use other examples, I don't think there is any problem.
Okay. Another question is for the insurance company, the company will have thousands of different assets, and their portfolio is huge. Right? They want to calculate. One method to calculate the VAR is they can calculate one VAR for each asset.
No. I calculate the value at risk for the entire portfolio. So this one is calculating. So exactly is your question.
Yeah,
when
I know
insurance
that.
company consists of thousands or 10,000s of assets, then how can you compute the VAR? I think that this method is ready to really decided to solve that kind of problem.
So can it be used to the situations that we have thousands of?
Sure. So it is constructed for that purpose.
Okay.